So rents have been flat-ish.
Mostly flat.
Interest rates went up, expenses gone haywire.
Taxes are up, insurance are up, everything's kind of up across the board. And I think things will start to break open. You'll start seeing more tenants start to lease. You'll start seeing more owner users want to buy. I think it is a time of opportunity.
Hey, Colorado real estate investors, Chris Lopez here, and today's podcast is diving into the industrial asset class. So we got a top broker from NorthPeak to come in here and talk about market trends, talk deals, and just talk about the asset class in general. But before I introduce him, let me introduce my co-host today, Matt Malloy with the Property Llama team. How's it going, Matt?
It's going well, Chris. How about yourself?
Doing great. Excited for today's podcast, and you helped tee this one up because you used to work with our guest today. So introduce him, please.
Yeah, it's my pleasure. My pleasure to introduce Drew Williams with the NorthPeak Commercial Brokers Industrial and Retail team. Drew's a top young broker. He's really been heading the industrial team for the past couple of years, and he probably one of the smartest people I've ever met. No pressure. And just a great guy. So thanks for having us.
Yeah,
thanks for joining us, I should say.
Thanks for having me. I appreciate that intro. I don't know how I deserve such a great praise from you. So
now you gotta live up to it.
I know. It's like, oh, here we go.
So before we get into details, just talk a little bit about who you are and what you do at NorthPeak.
Yeah, absolutely. So I joined NorthPeak about 4 years ago. I think it's coming up on the 4-year mark. Before that, I was actually in tech consulting and taught school at CU Boulder for a quick sec as well. But, when people say real estate found me, I guess that's kind of what happened with my old roommate, Hunter Schaefer, who's also a multifamily broker at NorthPeak, kind of brought me in, which was super cool. And I really appreciate him for that. But been with them for about 4 years now, focused on mostly industrial multi-tenant, really 5 to 50,000 square foot. We also do single tenant. We do retail. We'll do another triple net assets. We've sold some office buildings. Majority of it is in Colorado. We have done a few deals out of state, a couple in Ohio, Connecticut, so on. So that's primarily our focus, probably the $1 to $4 million range, multi-tenant industrial assets around Denver.
Awesome. I want to dig more into this kind of like industrial as an asset class. Mm-hmm. So I was, for our listeners, I was telling Drew before, me, like a lot of our listeners, kind of traditional landlords, single family, multifamily, that is where all of the bulk of most of our investments are. So from like the 30,000 foot level, when people say industrial, what's the umbrella? Like, what does it encompass?
Sure. And that's a great question. And it's pretty broad. I like to compare it to even single family homes. Like you have your starter homes that are maybe a lot smaller, 1-bed, 1-baths, and you have these, Bezos type mansions that are 30 bedrooms or something like that too. And so you have a pretty large range of an individual asset class as well. That could go from an individual user at, call it 2,000 square feet, maybe even less, small building with a little bit of land, all the way up to, million square foot complexes that are broken down from, 20,000 to 50,000 square foot bays. So you get things few and far between. And then you also have individual tenant stuff that is also can be a lot larger or smaller too. So broad range. I don't know if that's a great help for the overarching, but that's why we like to specify that we really focus in that $1 to $4 million range, sub 50,000 square feet, because it hits a lot more of the, mom and pop, small syndications, those, less institutional type investor type stuff.
So walk me through a couple from a high level, and that was a great overview, by the way. Just like you talked about, like a deal for like a syndicated group, a deal for maybe an owner user or an avatar, and just someone who they're going to be a landlord, they're going to buy it and then rent it out. Kind of like are those? Did I hear you correct? Those kind of like the three
those
profiles?
Are exactly. That's probably the three main profiles, and a good example of that is we sold a building not too long ago on East Smoky Hill. To an investor of ours that we've sold buildings to in the past, and it's got a 15-year automotive lease in it, right? So he's just there to park his cash, make good return, hope that it appreciates over time, tenant steady, all that good stuff.
So that was a single tenant
automotive.
Okay.
Yeah, so that's kind of one of the things we've done recently. Another thing we've done or currently have listed is a building over in Inglewood that would be more for an owner user. It's a 10,000 square foot warehouse, a little bit higher clears, 18-foot clears, 2 drive-ins, 2 dock highs. So it gives the tenant a lot of good access to space, whether they're getting shipments, whether they need to have a fork in the back, whatever it may be, with a little bit of office up front. So that could be a better user deal because the current tenant has moved out and so now it's vacant, right? So it opens your door to have an investor come in and lease it for an investment, or a user to come in and occupy it. So that'd probably be the second class as well. And the third is maybe just more traditional multi-tenant investment on the syndication. You've got a group of investors that are looking to place funds, whether it's from prior 1031s, whether it's from just a new fund they've raised, and they're looking for maybe an Oneida type deal that we sold last year at $5 million. It had 15 tenants, a range of spaces between 1,500 and 3,000 square feet with dedicated yard. So easy to lease space, high clear, good rigidity, will help you, in any type of vacancy, mitigate that risk.
Okay. That's great overview. So to just drill down on the details, what are are these more turnkey? Are these, value add? Are these buying a big building and, taking a big building into 10 smaller industrial bays? Kind of what are the investment strategies people utilize in industrial?
Sure. The main two probably are value add industrial. And that's pretty broad as well, right? You have anyone that wants to go in and do a lot of capital expenditure for a new roof or upgrade electricity, whatever it may be, or you have kind of more of a mark-to-market strategy where the leases are low. Maybe they're a net or a gross lease currently, and they need to be transitioned to a net lease. So you're recuperating more of your cost or mitigating more of your risk down the line. So that's kind of, one or two of the value add facets. And then you have your more, I don't know if traditional is the right word, but a secondary lane of investors that are looking to place capital just for long-term investment purposes into a stabilized asset. And for example, we have 3600 South Huron listed. It's a single tenant, could be multi-tenant, more flex industrial building. The tenant just signed a 5-year triple net lease. So they're in there for, 5 years plus an option. And so we had a 1031 buyer kicking the tire around to say, hey, this is a good investment. This is something we may entertain.
Okay. Define when you say flex industrial, what does the flex part mean?
Yeah, and I think that's a great question because, what's small bay, what's flex, and there's so many different questions for me.
And talk to me like I'm an 8th grader.
Yeah. And for me, and you'll probably get a different answer for everyone you talk to. It's similar to an accountant, right? Like a small bay, 10,000 square feet and less. I like to think a small bay is maybe a 5,000 square foot bay and below.
Okay.
And then mid bay is maybe that 5 to 10, 5 to 15, and then maybe larger bays 20 plus. And then the flex aspect of it is more of how much of the space is comprised of office versus maybe more traditional high clear warehouse. And so we see a lot of our warehouse buyers and tenants really looking for 5%, maybe up to 20% of the space being office and 80% or more being warehouse. Whereas flex, you start dipping above that, call it 30, 40, 50% office, and then more industrial in the back. And so it can host is we do leasing for a building over in La Pan. And so you can host an HVAC company and have front office folks there, and then also have a warehouse in the back that the technicians can get their trucks into, their supplies, whatever it may be. So it's more of a split type space, maybe compared to more pure industrial.
So when people say flex, that's really just a decent chunk of that space being office.
That's how I normally look at it. You can also get flex retail too, where maybe there's more of a retail component up front for maybe auto sales or manufacturing or whatever with certain components. And then in the back is where they have a warehouse. So retail, industrial, flex, it really depends on how you define it. And that's how I like to look at it, just based on what I've worked with in the past.
Perfect. That makes a lot of sense. You talked about you mentioned one of the deals, I forget which street, but it was the stabilized asset. You did 1031 buyer kicking around.
Yep.
I'm just kind of curious. I'd love to kind of walk through some deals on, a stabilized purchase.
Sure.
What's the rough cap rate, projected return, financing structures, kind of what's the high level metrics of the deal like that?
Absolutely. And so on a base level, I think most people look at a cap rate, right?
Yep.
And that was right about, I think it's a little bit below a 7% cap. Again, that's utilized because we have a tenant in there for 5 years. I normally look at cap rate as an adjustment for risk.
Yep.
Normally your cap rate's got to increase if you've got a tenant with a year left and it looks like they're going to leave, right? The other components to that are going to be how stable is the tenant. I mean, that tenant does some pretty cool stuff. We have limited insight to it. They manufacture currency. I don't know, not the actual currency, but dies for currency. So they're currently in the running to win the euro production for, the next time around. So we have a little bit of limited insight, but their concept is really cool. They've bought some warehouse space down in Mexico for production. They're looking to expand in Denver. So you look at the tenant like that and their growth, it helps to maybe ease certain investors' worries about, is this tenant going to be here for the full duration of their lease, or will they extend? Or is this like, hey, we're about to inherit a 10-year lease, but they're insolvent? And so it's all these different questions that may mull around to make sure you're in the right asset class or the right, cap rate for the perceived risk.
Because from my understanding, a lot of the underwriting you do, whether you're buying a building or getting your tenant in there, is you're really underwriting that business, right? That's kind of the bigger risk for like, hey, what's that business's credit worthiness, and can they pay the bills, right?
Yeah, it's part of both, right? If you have a great space and it's going to be really easy to release, some of the owners will take maybe a bit of a flyer on a tenant that may be a little shaky. If you have a space that's highly specialized, a swim care or something like that's got a pool in it, it's going to be a lot harder to release if someone leaves.
Yeah.
So you may get a much higher rate of return up front, but if that tenant goes, who are you going to put in there? another pool? You going to fill in the pool? I mean, it's all stuff that you underwrite, right? It's all taking account for certain risks. Because at the end of the day, there's always things you can't even account for. There's always unknowns, and it's just about getting comfortable. And for me, a lot of it is like, is this good real estate? Is it functional? Is it in a good location? Will it appreciate over time? And like, do you have control over your timeline? Because if you buy something and you're short on cash, something comes up, whatever it may be, and then you're forced to sell, that's a recipe for potential disaster. Whereas if you buy something on maybe more market economics and you're looking at something from a more base perspective up, it's flexible, and your tenant leaves and you can release it, you're going to feel a little better about it.
So going back to that example with the stabilized industrial, about a 7% cap rate, and good lease, good tenant in there. What's the financing like in there? Is that like a 30% down payment, 40%? Kind of what are the terms that banks or lenders give?
Yeah, another great question. I think a lot of our investors look at it where they want at least 100 bips of spread on the cap rate to the debt.
Yep.
And so if you're looking at a 6% interest rate, they want it to be at 7, right? Plus or minus, 150 is probably even better. Obviously, the more spread you get, the more return you're going to get as well. Maybe that starts to capture a little bit more risk. Who knows? And so a lot of the stuff we've seen maybe a couple of years ago was 30% down at the minimum. Now it may be closer to 35, 40 because your debt payment's going to be increasing with the interest rates as well.
Yeah.
And so banks are going to look at you to cover at, 120% of the income of the building, maybe 125, 130%. So because of that, it's increased the down payment to help that lever come back up with the debt coverage ratio.
Okay.
Yeah, you think the DCR is kind of like 1.2 to 1.4 now? Is it?
Yeah, like 1.3 is probably a good average. And I think you're incentivized a lot of times to, if you can put down more.
Sure.
Because if you're looking at, your interest rate versus the bank, the more you can put down, the better your cash on cash is going to come back. It's hard to find a deal where your cash on is, the opposite of that. I call it the bank cap rate. You almost look at how much the bank is getting yearly over their overall loan. And that's probably, considered a 9 cap at the bank, whatever you want to call it.
Wait, walk me through that again. I lost you. Somebody said this, a bank cap rate?
Yeah, that's what I like to call it. I don't know if that's the actual name for it, but you can look at your yearly payment on a loan. So the math
like just my interest?
No, I do both. So it's like
interest and principal.
Yeah, you look at interest and principal. So the building over on Huron, we were doing some math. It's like, let's say you buy it for 1.7, something like that. And your yearly payment at 6% is like $115K. And so $115K divided by the overall principal of the note, which is going to be, I don't know, call it 1.5, something like that. Because you're taking 20% down payment, whatever it may be. That ends up being, I don't know, call it 8%. And these are all hand waving numbers. So sorry if my math's off here. If your bank rate is ever below your cap rate, so like if the bank rate is say 6 and your cap rate is 7, that's when you want to leverage up because your cash on cash is going to go up over time. Whereas if your bank rate is above your cap rate, call it 8 for the bank and 7 for you, you want to put down more to increase your cash on cash. And that's how that relationship works. So you'll see guys, if you can put down the minimum and it works, you can make it pencil, that's great. But right now, if you can put down more, your cash on cash will increase. It will hit maybe your IRR down the road, depending on what your levers are on the way out. Like what are your assumptions for cap rate when you sell? Some other things like that. So,
okay. Great overview, man. So walking forward on this deal, let's just say, I mean, a lot of times for my residential multifamily investments, I have, a 3 to 7 year kind of like window where I think I'll sell or cash out and refi, right? What's kind of for like, again, that stabilized asset, the expected hold period, is that a 5-year hold period and look to turn? What's the hold length that's common? And then kind of what's the overall IRR when they do exit?
Sure. I mean, IRR is always interesting because it's so much assumed on the back end with your exit cap and whatnot. So I try not to focus on it too much unless I'm working with an individual investor that really is like, this is our target. These are our assumptions. Because there's just so much you can change to make you can handpick a lot to make it work.
That's how pro formas work, right?
Yeah, right. So it really just depends there. In terms of everything else, I think you're looking at it from the bank and you're looking at caps and you're thinking, hey, I'm going to hold this for probably 5-ish, plus or minus 2. So the same exactly that you said. Is it 3 to 7? Probably. There are investors that are going to hold it longer, 10, 15, 20. They're just really long-term investors that never sell. Maybe their plan is to buy in zones that are going to be future developments. So they're really doing like a covered land play to some extent, whatever it may be. But a lot of more traditional investors are probably on a 5-year to 7-year. And so they're underwriting their exit about those timelines. It is flexible too. Part of the thing with some of these stabilized investments are if you have a 15-year lease in place and every 5 years, like the auto one we just sold, every 5 years, their rent goes up like, I don't know, 5, 10%, whatever it was. As you own that, the value can also decay. Because if you're trying to sell the same asset in 7 years and you originally bought it with 15 years on the lease and now there's only 7, that incoming buyer is going to see that too. Okay, well, are they going to extend? What's this looking like in my 7 years when I have to sell this?
Right.
So I don't know. It's all fun, right? It's like who's going to buy what and when and why and what's your profile and how can you match that with someone else's profile on the exit? How do you match your profile with someone else's exit on the way in? It's hard to say that everyone's the same, right? Everyone looks at things differently in terms of risk profile and whatever it may be. And so you kind of just go with the flow and certain people are willing to do certain deals and others aren't.
And what's the conversation right now with investors versus maybe like owner occupants, right? Maybe like what's the upside of getting your own building versus what are the conversations, how they shifted with investors?
Yeah, I think it's been really interesting to see it progress throughout my 4 years. I came in right as interest rates started to go up. And so we had a few deals go through where interest rates were still mid 4s, something like that, high 4s. And then over the last couple of years, they've been 7, and now they've kind of maybe snuggled back down to mid 6s. I don't know. If you go long-term life co, maybe you get less. So it's been hard for investors specifically to make things pencil because a lot of these leases in commercial buildings are on a 5-year, 3-year term. And so you don't have the quick 1-year flip with maybe multifamily. You're kind of locked into a longer term investment that's harder to push at times. And so when you do go to buy something, I remember the first deal I sold in Denver was over on Tejon Street. And the guys were paying probably half of market rent. And they were on a gross lease. It was minimal. We had some buyers that wanted to buy it. The owners actually built the building back in 1996. And they were willing to provide an owner carry because the note had gone up so much from in the traditional bank that they couldn't justify, like a bank wouldn't really fund it because the rents are too low. They don't have proof of better income. So the owners said, okay, we'll give you this at a better rate to get a higher purchase price. So everything's flexible, right? It's just been really interesting to see how things ebb and flow with different investors. And then to your point too, with owner users, I think we saw a couple of years ago, maybe the gap between purchase price for users was higher than an investor because interest rates were lower. And now that gap has kind of compressed and you see buildings that are sitting vacant longer, even though their basis in terms of price per square foot may be lower. And that's probably due to a lot of market uncertainty, right? You have so many different geopolitical factors, interest rates, wars, Venezuela stuff. Like there's so much going on that a lot of these guys that are trying to upgrade from 2,500 square feet of renting into a 5,000 square foot building, it's hard for them to justify it. And they just have too much kind of fear to go and do so. So they're kind of at an impasse right now to some extent.
And so you think that with like, just to summarize that point, it's like, so if someone was trying to upgrade their space or get a bigger space, the and maybe they could hang on to a
Mhm.
building for a while to try to get an owner occupant pricing, which is always traditionally a higher price.
A little bit, yeah.
Yeah, do you think they're kind of like closing the gap and just kind of selling to whoever it makes sense to sell to?
Yeah. I think since investors having a hard time penciling similar deals to what they were in the past compared to users now, and them also having a little bit more of a hamstring on rates and a few things, it's really closed that gap between the two. And so maybe as a user, you could get a better deal, and then your upsides are depreciation, building equity in the building, having insurance that you can just stay there. If your building gets sold and you're at the end of your term, they might double your rent and then you're going somewhere else. Right. So those are all pros. The cons are you're probably going to pay a bank a loan origination fee. You may be stuck into an SBA, which may not be very flexible. If business is tough, I mean, are you collateralizing your house? If you lose a rental, you may get sued for a little bit of rent, but you're probably going to be okay. If you lose your building, it's going to be losing the building to the bank and maybe more. So it can provide a little bit more stress on users. All the things said, I don't mean to come off as negative here. I actually think there's a lot of positives here with users being able to take advantage of a time of uncertainty, or investors as well. I think we've seen sales prices in terms of price per square foot kind of bottom out. They did go down a little bit. You're seeing them, the last 12 months is probably a range of 160, 180 square foot up to 200. Then the last
that's in Denver?
In Denver, yeah. Like kind of the C470 circle is what I normally look at.
Sure.
And then you look at maybe the last 6 months, and it's come from, 160, 180 up to 200 down to 150, 170, high bar of 190. You always have a few outliers, right? And then the last 3 months, it's down to, even just a little less than that. So you can always look at averages. You can always pull out outliers. You can always, on both ends, high and low. And you'll look at kind of these trends, and it feels like it's starting to stabilize. And I think we're seeing more tenants engage, more buyers engage, and starting to thaw. You can only wait so long. It's been 3 years of these high rates and low volumes.
Yeah, eventually something will start going. All right, so it sounds like I was trying to follow the square foot prices. Is that like a 10 or 15% decline? Would you say? Is that my mental math right?
I think the last time I pulled it, you were looking at a 15% pullback from ask to close price.
Is that like year over year? Just kind of like from peak to the trough to where we are now?
That would just be based on what you listed at versus what it sold at. Year over year. Yeah. So we've seen that if you list it, call it $1 million, you normally sell for 15% below that on average for the last 12 months.
I know a big part of a lot of us multifamily investors say we had all the supply, rents got soft. Interest rates went up. What's driving the price correction in industrial? Is it just high interest rates, or is there a wave of supply, or have rents or operating expenses gone haywire?
Yeah, that's a good question. It's a mix of everything, right? Interest rates are up. That's probably the biggest and quickest deterrent.
Okay.
Second, rents themselves have somewhat stabilized. You had people underwriting maybe triple net leases at a couple of years ago, $12, $13 a square foot triple net, thinking in 3-4 years they'd be closer to 15. And all the leases we've done recently are 12 or 13 bucks a square foot.
So rents have been flat-ish?
Mostly flat for new. You'll get tenants that are in there for 5 years that are paying more that are just stuck in the lease. But yeah, I would say 12, 13 for a space that's probably 5,000 square foot or less is probably there. And part of the reason they haven't gone up is, to your other point, the expenses. I mean, taxes are up, insurance are up, maintenance costs, whatever it may be, everything's kind of up across the board. And so when you're wrapping a lot of this into a triple net lease where the tenant's responsible for paying for your taxes and for your insurance, it's going to cut out what you can charge on a base rate.
Yeah. So
net effectively, if you were to hold expenses the same from 3 years ago, you probably would be at that $15, $16 a square foot base. But since nets have jumped from $4 or $5 a square foot to $6, $7 a square foot, it just takes a direct correlation out of your total monthly amount.
I want to talk about, we spent a lot of time talking about stabilized. Walk me through, what's the value add industrial look like? A recent deal or one of the deals you guys are marketing now, kind of what's the play on value add industrial?
Yeah, absolutely. And the main one there is probably just increasing rents from a gross lease. And maybe, you look at certain buildings that have been owned by a mom and pop for, call it 15 years, right? And they've had the same tenants in there. They're not even on a lease, right? They're on a handshake deal.
Right.
they're paying, I don't know, $5,000 a month for 5,000 square feet, something like that, all in, and then the owners are taking care of taxes, insurance, and they're kind of getting crushed because your taxes went up 30%, whatever. So a new investor can come in and say, hey, we'll give you kind of the in-between. We're not going to buy it on a pro forma 7 cap because we're going to do all the work. We're going to pay the leasing fees. We're going to do a little bit of TIs, whatever. Right. But we're also not going to just completely lowball you and say, like, we'll buy your current at a 9. It's so most of the investors I work with are pretty good at kind of finding the middle ground of like,
Okay.
hey, if this was on current numbers and there was no upside and we're looking at a 7 cap, this is what it'd lend to. Right. But it's not. And here's the amount of money we're going to put in for TIs, brokerage fees, so on and so forth. And can you carry? Can you make our returns better by carrying a note? And then they'll go in and they'll say, hey, Mr. Tenant, you've been here for years. We'd love for you to stay, but the tax liability for us is too much. So we need you to start paying nets. And we're going to slowly increase you to a market rent of closer to $13 a square foot. And so that's maybe one of the more traditional plays. Just, I think we call it mark to market, where you're increasing rents from sub-market to market. The other would be, value add. If you want to go really heavy, is there a building with, environmental issues where you got a phase 2, you've got to do remediation, you got to dig up 6 feet of dirt and get rid of it, bring new dirt in, then lease it to a new tenant. That could be more heavy value add. It doesn't need a new roof. Roofs are expensive. We're talking $100,000 for 8,000 square foot roof or something like that.
Yeah.
So is that your value add play? Is it taking a vacant building or a building with deferred maintenance, buying it at a discount, doing the maintenance, and then releasing it to a tenant at market rent?
Okay.
So those are probably 2 of the more main value add propositions.
Great explanations. I know this is a hard question, but kind of what's the typical business plan timeline? Because hey, multifamily, no, usually 12 or 18 months to turn around a building. What's elected for a value add in an industrial?
Sure. And a lot of it's going to be dependent on your leases up front, right? You buy in, what is it? It's almost February. You buy today. Let's say you close today. And the building you're buying on a value add for mark to market on a lease, maybe one tenant's lease burns off in June and the other tenant's burns off in November. Right. So you'll probably approach the tenants quickly and say, we want to sign you. Here's your proposed lease. You can continue your current terms till the end of it, but your new one, here you go. And you'll quickly find out if they're going to leave or not.
Mm-hmm.
And they probably will half the time, maybe more. From there, you'll start doing your marketing for the certain space. And we've seen lease up kind of jump from, if you're chasing like true market rents and trying to push the boundaries of what you can get right now, you can see leasing take 4, 6, 8 months. I mean, it takes time. You're seeing tenants ask for more. They're asking for free rent up front. They're asking for TIs to improve the building. So it's more of a lever you got to worry about. If you are able to get in on a good basis and maybe get a distressed buyer or something like that and capitalize on that, and you're not chasing high barrier, markers for rents, you could probably lay off that a touch and lease things up a little quicker. It's still going to take 3-4 months.
Okay.
It's just the lack of tenant involvement has been prohibitive over the last couple, years. Even the last 2 years, we've seen a little bit of a slowdown compared to when I first got in. It's like you had a space for lease and you had 15 tenants that wanted to expand into it. And now it's, you tour something once, twice a day or a couple times a week. And it's like, I know you're listed at, $10K for this 5,000 square foot lease, but I can do 6,000. You're like, oh boy, this isn't going to work. So it's just more time, more effort, more traditional brokerage, right? Knocking on doors, calling people, looking at the neighbors, calling similar product types. A lot of this space is good for HVAC guys, lumber guys, trade guys, whatever. It's like, okay, well, I'm going to call all the HVAC guys in this area. When's your lease up? Do you own your building? Do you want a new one? Just find out. And so that's how we've driven a lot of our activity recently, is more outreach than just inbound.
I like that. That's smart strategy to reach those potential investors. All right. So a few minutes ago, you mentioned prices have dropped. There's some good opportunities. Give us over the next, 1 year, where the opportunities are, whether certain investment strategies or locations, kind of what's the what's the opportunity next year or two for people interested in industrial?
Yeah, no, absolutely. I think it is a time of opportunity. I think, again, we've kind of things have gotten not bottomed out, but things have flattened at the bottom a little bit. So which way is it going to tilt? The hardest thing I think recently has been that there hasn't been a direction that it's going to go one way or another. So people are just holding.
Yeah.
And I think things will start to break open. You'll start seeing more tenants start to lease. You'll start seeing more owner users want to buy. You'll start seeing more investors get creative and be able to meet their metrics, and deal flow will start to increase again. And so I think if you're in the Denver metro area, a lot of the things I look at that make a building very valuable. Do you have some yard for every tenant? Do you have good clear heights? Do you have good access? Those three can go a long way. And is the building brick? Maybe is like a little bit of a surcharge for brick compared to metal siding buildings, but whatever. Because if you have buildings that have a little bit of yard, you have more tenants that will likely need to use that yard. I mean, we've had maybe struggles in the past to certain spaces that are great, and they have 2 parking spots outside.
Sure.
What are you going to do with anyone coming to your business? What are you going to do with your employees? It creates a pain point. Same thing with clear height. Hey, we've got a great building. It's only got 12-foot clears. Now you're looking at a price per cubic foot that's going to be higher than it would if you had 20-foot clears. So people can't stack, right? You can't go up vertically. We're working with a glass company guy right now who is looking to expand, and we're talking to him about Raritan, which is a 10,000 square foot building with 20-foot clears, I think. And we're kind of saying, hey, this is great because you need more than your 5,000 square foot currently. 9,000 is good. And then in 5 years from now, when you need to grow again, you don't have to go sell the building and buy a new one. You can now go up. Like you can just start stacking, So there are businesses that can't do that. But a lot of these other guys, it's just an added benefit with clear height.
So that helps, I guess, future-proof the investment.
Yeah.
What about the next 5 years? And this can be for Colorado in general, just what's the asset class look like? And for me as an investor, this last market cycle change has made me really step back and look at, medium and longer term trends, and also try to understand more the macro trends, right? So
yeah.
Some of the groups I follow and just some, articles I've read, you've got, right now a big push to kind of, I guess, reshore or onshore, manufacturing in America.
Sure.
What trends do you see? And to keep kind of just brainstorming out loud, part of me says, hey, there's a big opportunity on there, right? Hey, we're going to bring back manufacturing on here. So it's going to be a surge in industrial. Or is, hey, if the next administration gets elected and someone else is in charge, are they going to completely change that direction? And then that'll make it tough. So yeah, just some thoughts on give us the medium and longer term, I guess, threats and opportunities that you see.
Yeah, no, that's a great question. And I think a lot of that you look back to help answer, right? And I think we've seen since even 2008, 2009 with almost a zero lower bound on interest rates, you've had a group of both owners and investors that's all they know. And so they're used to low interest rates. They're used to buying a multifamily building, renoing units, bumping rents a ton and selling it a year later for a pretty massive profit.
Yeah, those were great days.
Yeah, great days, right? And so I think we're seeing a return to average, historically speaking, where you're not hitting home runs every single deal. You're looking for those singles and doubles that are going to be more based on traditional investment returns and long-term success of real estate. And so I think that's what people are coming back to normalize from. I think some of the threats to your point are I look back to, 1980 with Paul Volcker and stagflation. It's we had some inflation going on. It seems like we've been able to tame that a little bit with rates. If we cut rates now, is inflation going to go up? Is that going to cause more long-term pain, or are we almost through to the next window where people adjust? I mean, I think traditionally speaking, interest rates normally are above 6%. If you look at even the last 30, 40 years.
Yeah, historical averages, but we all have that
the
recency bias.
Exactly.
That's something I'm I'm used to the last 15 years.
And so I think we're getting through that pain point of the recency bias where a lot of people are used to having home run deals, low interest rates, appreciating assets to maybe a clip that you haven't seen before, and they're normalizing back to the mean of buying real estate for a long-term purpose and just more based on fundamentals, right? You've probably had to get a lot more strict with your underwriting for rents. We've all had to come to understand that expenses have gone up.
Oh yeah.
These are all things that people are seeing, and now they're making deals work on a basis that's more similar to times maybe in the 2000s earlier, or something like that. So it is interesting. You know, you see the population growth of Denver, it's slowing. It may be net negative even a little bit this last year. So that's a factor. I think the Denver market as a whole is a little bit more rigid than a lot of others, and maybe rigid is the wrong word, but more of a sure thing than a lot of tertiary markets. And, you know, we did a small deal in Torrington, Connecticut, north of Stanford. It's, you know, like what's in that town? I don't know. Like, it's a medical office, so that helps. You know, medical office stuff is normally pretty rigid. But on a long term, I think you are going to have opportunity with manufacturing. You are going to have opportunity with people being more based in fundamentals than assumptions, maybe compared to the past couple of years.
Have you noticed any material impact from like, federal policy changes of, hey, we're trying to, the tariffs, we're trying to bring more stuff, has like, what's that done either in terms of like interest from investors, interest from owner users, or people like, we're buying this now because we're bringing this back on shore, or what's the sentiment and what's being translated into deal flow?
Yeah, I think it's been really interesting because you probably remember even a year ago calling before the election, let's say, we got a lot of objections of, well, you know, and I'm not trying to get political here on either side, but it's like, oh, well, if Biden continues for certain owners, it was good. And for other owners, it was bad.
Yep. Yeah, for sure. Definitely remember that.
Then after the election, we knew the results. And you go back to the same guys, and Biden, the people that thought Biden was good, now they're, you know, oh, we got to hold on and wait to see what happens to Trump. And then even the ones that wanted Trump to win, they're like, all right, well, now we got to hold on and wait to see what happens to Trump. And so it's like, I think a lot of people use election cycles, whatever it may be, you know, global conflict, as a way to defer when they're uncertain.
Absolutely.
And I think a lot of investors that are maybe finding creative ways to guard against that are the ones that are benefiting the most. Like the ones that are taking action and being proactive and saying, okay, well, we're going to guard against this by looking for longer term leases, maybe a little below market so our tenants want to stay. Hey, we're going to guard against the interest rates fluctuating by getting a loan that we can refinance with, you know, minimal charge, right? Oh, maybe we won't go to a life co on a 10-year because the prepayment penalty is insane, right? So you're like, you have guys preventing or guarding against these new factors. And then you have guys sitting there bitching about them, which is fine. Like, I get it. You're throwing millions of dollars around. You should be comfortable. I think there is opportunity for the ones that are going to get more aggressive and find creative ways around it.
But so far, you haven't really seen any big, like, other than obviously the uncertainty holding pattern, even seeing like material changes in people's actually like, I see, you know, hey, writing a check is the ultimate. Hey, you have confidence, please. I'm writing a check, I'm investing. I believe this. Like, you haven't seen any material impact from a lot of, like, you know, Trump's policies.
I mean, it just goes both ways. I think policy aside, you see consumer sentiment, and it's been a lot more shaky. And I think that drives spending in the retail sector. And if that pulls back, tenants leave, and then vacancy rates go up, and it starts to hit all around. The policy one's always so interesting to me because it can be pretty broad, and a lot of the impacts aren't known until well down the road. You know, I look a lot of it like education policy. I'm 30 now. Well, I'm about to be 30, and like the effects of Bush's education policy are just now being like really figured out, right? So you have a lot of these things are really lagging. Like, do you really know what the Obama tax plan did from 2010? Like, we might see a little bit into it, but the market's so complex that it's always so hard for me to say, hey, you know, this one policy is doing this. I think tariffs are more of a question that's more seen because it's like, it's very simple and direct. It's, hey, China, 300% tariff, have fun, and then negotiate it down, whatever it may be. And that's a very direct correlation, but so much policy has so many different things wrapped up into it, whether it's funding for certain things, and there's no single issue bills. It's, hey, here's the new tax plan that does X, Y, and Z, but it also does all of these other things.
Here's the omnibus bill.
Yeah.
Yeah. So kind of taking this down to the state level, and then I just say, as I've broadened my investor skill sets, looking at policies again, not to give my opinion, but just to interpret what's going on. So we can bring it down here to the state level. So for a lot of like residential landlords, the policies last couple of years have just made it a lot tougher, especially for like attainable workforce housing. I'm curious. I know again, that's the policy changes I've focused on in Colorado, but I know some of the other ones have had made it tougher for some businesses or some industries. Has like the industrial asset class. Has there been local policies, either Denver or Colorado, last couple of years that have been the kind of equivalent to residential? It's made it a lot tougher, or it's driving business growth away. Like, what's been local policies like?
Probably the two biggest I hear, especially in Denver, are taxes. Just the commercial rate for taxes is pretty high.
Oh, yeah.
And then the other is going to be more of Energize Denver and them trying to push for LED lighting and other types of, energy efficient means within a building.
And that includes industrial as well?
Yeah.
Okay.
And so you'll look at, we had some guys in the office a little while ago talking about based on building size. And so right now, and I could be wrong about this, but ballpark, it's like if your building is 30,000 square feet or more and you don't hit these benchmarks that the city has lined out for you, you'll get fined. And
they're big fines
they can be pretty substantial. And so it's like, hey, do you want to go spend $50,000 on LED lighting and some other things that will get you in compliance? Or do you want to get hit with a $30,000, $40,000, $50,000 fine? And like a lot of the owners, it was rolled out kind of quickly. I don't think there was like super great awareness of what the penalties were going to be and what the timeline needed to be. And now people are playing catch up. And so that's been a pain point for maybe more industrial owners. I think to your point, we've seen a lot of investors move from multifamily into the industrial triple net retail landscape because of how difficult it's been in multifamily.
So you've seen, you've seen investors shift from I know multifamily is usually where most investors start, and then people end up diversifying away. So you've seen that pattern.
Yeah. And that was part of the reason that Matt and Kevin hired me initially, was to grow the retail industrial triple net arm of NorthPeak, because they had so many clients that were selling and 1031ing into assets like that. Because it's a little less hands-on. If you have an absolute triple net, we call it just coupon clippers.
Way less hands-on than a multifamily.
You're just getting a check in the mail for some of these guys. There's a range, of course. Like there are owners that are more hands-on than others, but you're talking a 5-year lease. You're not renoing a warehouse every year. What's the rent on a warehouse? Like you sweep the floor and paint? Maybe you build a little office space here and there, but it's just a little bit less upkeep and a little bit more stability. And I think a lot of the policy for multifamily has driven people into alternative asset classes that maybe they hadn't considered in the past.
And on that thought, what are some of the things you would tell an investor who's switching from multifamily to industrial? Because like in my experience, I think you touched on it a little bit earlier. It's like in industrial, they can be very, very, like buyers are very specific about the size, the type of building, the type of HVAC that it has.
Sure.
Just like they know their infrastructure, right, and what they need. So what would be a piece of advice you'd give someone who's transitioning from multifamily into industrial?
Yeah, that's a great question too. I think you really got to, again, just kind of go back to the basics when you're transitioning to something like that. Like, can you get a good basis and can you get a building that fits a lot of tenants? Again, the swim example, it's like you can buy an absolute triple net swim school on a 15-year term. You're perceiving a little bit of risk there because of how specialized it is.
Sure.
I think a lot of the investors we work with that have come from multifamily, like a multi-tenant industrial that has high clears, a little bit of yard, 3,000 square foot bays and less, because there are so many tenants that fit into that profile. I think you look at it and it's like tenants that need 10,000 square feet and more, there's like 3 times as many tenants that need 10,000 square feet and less. Just because you're getting a lot of those guys upgrading from their garages, looking for 1,800 square feet. You're getting the guys in 1,800 square feet looking to upgrade to 4,000 square feet. And you have a huge mesh of just small business that fits into these spaces versus, the Amazons of the world that are looking for 500,000 square feet off of I-25. how many companies are ever looking for a 1 million square foot campus?
Right.
It happens. Sure. It's highly specialized, but for an individual investor coming from multifamily, I think the small bay multi-tenant industrial and small bay retail is a pretty natural transition that overlaps a lot of the skills that you may have, where you can still manage them yourselves and deal with, when things break. Again, if it's triple net, they're kind of on the hook, but hey, here's the contractors I have from the past that can help you with this. Hey, I've got a better time horizon where it's a 3 to 5 year lease instead of having to lease this again next year. So yeah, just getting comfortable, familiar, understanding how to mitigate risk is probably the biggest couple things that I would focus on for someone transitioning between the two.
And that makes sense, right? It's can be, as you said, like how many people do you have to mitigate it? How many potential businesses do you have that could come in and mitigate vacancy, right? Because if otherwise, as you said, like you could be holding that spot if you're really pushing rents for several months. Right?
Yeah. And that's what I love about real estate. It can be so complex and there's so many things you can account for. Like I love asking the question, like, what is market? Like a lot of people, I think market is average. It's like, well, this guy, if you take the average price per square foot, like why is this building priced $20 a square foot more? It's like, well, you're looking at the average. We've got 20-foot clears. That building's got 12. We've got an acre yard. That building has a third of an acre. It's a lot more of an art than I think maybe a lot of people think it could be, where they just see, but they're kind of the same size and kind of the same spot. So why is that one worth 30% more? And so it's about understanding all of those intricacies of, why is this renting for more? Why is this selling for more? Why is this not renting at all? And just kind of understanding different niches within even the Denver market itself, whether you're looking off Santa Fe and 285 and kind of the Inglewood pocket versus maybe the Commerce City pocket versus, a little pocket of industrial just not too far from your office here. It's just, everything's just got its little unique flavor that you should probably account for.
So I got a final question here for you, Drew. One of the, I'll say, probably worst investments I've made
so far.
You right there, Matt?
Yeah, choking on my coffee.
Yeah.
We'll make it through.
We'll rewind that one, Jules.
Chunky
time
coffee.
out. So the final question I got for you, Drew, is, one of the worst, or maybe the worst investment I made was bought an office building for owner user. And two big lessons I learned from there is, it's just under 10,000 square feet, but you can only have like two fairly large tenants, right? And if we're not there or the main tenant's not there, the numbers don't work.
Yeah.
And so I got very skittish about like single or very small, tenant things. Like, hey, what if I, as the owner user, leaves? Is this actually still a good investment? Because I compromise business needs, I compromise investment needs, and end up both being not good. The second is I have started focusing on just investing in nicer assets, nicer areas, more Class B plus or Class A versus Class C stuff. And you talked about yards and higher ceilings. So I'm, and maybe this is typical for some of your multifamily investors who are turning over, but like, how do you gauge the risk? Or you talk to someone like me who's, hey, I understand these single or, two tenant type buildings, but I'm terrified because you're either 100% or 0%. And then that terrifies me from just a concentration perspective.
Yeah, no, that's a great point. And I think it all comes down to your goals and what your risk tolerance may be. I think for you, if you can make it work and you have a steady, again, the tenant, if you know them well, are they going to be there for a long time? What does that look like? What does it look like when you move out? What's the leasing like on the back end, trying to replace someone to make it a full investment for you? And so, again, there's so much that can go into it. It's so personalized. My whole goal as a broker is to bring you as much information as I can to help you make those decisions.
Yeah.
At the end of the day, I can only tell you what I know and what we see. And then you can take that and you have your own risk tolerance. Like your perceived value is probably going to be different than mine, different than yours. Your risk tolerance is going to be different than yours, different than mine. And my job is to give you information to help you make those decisions. And so whether that's saying, hey, this office park you bought, it's in a great spot because you have great access to I-25 in Arapahoe and, you're right next to X, Y, and Z. And the office folks are going to want to come in here because you're next to a big box store or an anchored grocery tenant where they can go and get lunch there. And there's a Chipotle, right? It's things like that where you have to really consider more of just what's the purchase price and who's the tenant. It's also what's around it and why does it make sense and how can you future proof it? And so just giving any type of information that I think can help. I think a good example of that right now is off of 8th and 25. All of those warehouses right now, because we were just calling them on the other day. I mean, they're proposing a Broncos stadium right there. Like those people have the perception that their valuation just doubled overnight. And it very well could have.
If the Broncos trying to buy him, it's going to.
It very well could have. And it very well may. And so what's their perceived risk? Their perceived gain is that their property value just doubled. The perceived risk is that if they don't actually build a stadium there. It sounds like they're probably going to, but like, are you going to be the last one holding out where the Waltons say, yeah, we don't really even need it. Good luck. You drive around off like Evans and Bannock and you have all those new multifamily developments. And I love driving around there because there's warehouses there and there's multifamily developments and you'll see, one big development here and one big development here. And then in between, it's like this little 1,200 square foot house.
Yeah, the sad house I got left out.
And I'm like, dude, that is not where I would want to be. Like,
that's a great point.
Yeah, so it's like you got to catch things at the right time. I think some people get stuck in the like, I need maximum value versus security, and it's always a trade-off of where do you go with your office building, right? Is it something you sell to someone else? Is it something you tenant and hold on as an investment? Is it something that you stay in? The good news is you have those options. Hopefully you're not forced into selling out of context or leasing at another rate. The hard thing with office is just, COVID.
Well,
you're still seeing the effects and millions of square feet of vacancy downtown, right? We've had a little bit of success selling some smaller offices, call it like the tax professional office, 300 square feet, the, Eastern medicine, whatever it may be, little spaces within a maybe smaller neighborhood office. That's call it $1-2 million. That seemed to be okay, like the micro office, just because it acts more as a multi-tenant industrial, multi-tenant retail, where you're a little bit less worried about your long-term vacancy than losing one tenant and immediately being 100% vacant.
And on that point too, what I was trying to remember, it's got to be a zoning situation to where like what cities and what areas allow you to break down a 10,000 square foot building into 4 2,500 square foot buildings. Right?
Yeah, no, that's a great question. The zoning stuff for certain cities, and I'll give you an example. We were writing a contract for a property over on Federal Boulevard. It's currently a boat storage yard. It's got a 7,000 square foot warehouse on it. That's probably like 50-50 office warehouse, but it's on, I don't know, maybe 2 acres, something like that. And I had this owner user that wanted to use it for storage for his vehicles. And the city's like, absolutely not. They have their long-term goals as a city for Federal and Oxford to turn into banks, dentistries, doctor's office, stuff like that. And my heart goes out to the guy selling because it's like he's storing boats. It's not a conflict of use right now because he's been there for 30 years. But this dude wants to retire. And the city is hamstringing him to so few uses that can now come and buy it because how restricted they're being on what you can use the yard for.
And
right?
was that just like a change in the
zoning,
in the zoning and the laws, or is that like in the future zoning?
No, that's a change since he originally bought the building. Wow. And so you can continue to operate under your current use until the use changes. Yeah. But once you do a change of use, the city is going to be, doesn't comply. So that's been something it's something that I've tried to be really a lot better about the last couple of years is understanding zoning. Because if you buy a building and you, especially as an owner user, if you can't operate out of it, you just bought a really, really expensive paperweight that now you have to sell.
Yeah.
And that's going to be tough.
I'm just trying to think of the comparison on that from the multifamily space. It's like, imagine having a 12 unit and they're like, oh, this can no longer be a 12 unit.
Well, it's probably rent stabilized apartments, stuff like that, because I think that has a burn off period of 10 years. You would know better than me, but you buy a house or a multifamily kind of by CU Anschutz or something, and it's got government assisted tenants in there, and there's certain caps on what you can charge for rent. It'd probably be something similar to maybe that in terms of restrictiveness.
Fascinating. And I know there's a lot of stuff with zoning and yard usage, right?
Mm-hmm.
Yeah.
Yeah. So yard's fun because you'll have Inglewood and a lot of their zoning for like IMX 3, IMX 5, industrial mixed use. And then the number is just how many stories you can build. But a lot of their code is very specific to, hey, is your business to business or is it business to customer? And so another building we looked at that Howard Yard would allow you to operate a car like leasing dealership, like a Hertz, whatever it is, because your customer is coming to the business, they're picking up the car and they're leaving. That same lot could not be used as a bus rental company if your business had its employees coming to pick up the bus and then driving to a customer. So it can get that minute of a difference, and one is allowed and one's not.
Wow.
So that's something we've been dealing with recently, which is pretty interesting.
Well, that's, I mean, good you're catching on the DD
Yeah.
process, but that's stuff I've never even thought
Yeah.
about as, primarily as a multifamily investor. Drew, this has been a great conversation. If people are interested in learning about this or doing a deal with you, what's the best way for them to get a hold of you?
Yeah, you can call me. It's my cell phone on our website, email, whatever works best. So my cell is 303-917-5232. And my email is Drew, DREW, at NorthPeakCRE.com. And that's north like the direction, peak like a mountain, CRE for commercialrealestate.com. For some reason, a lot of people never hear me very well on the phone. So that's how I like to describe it.
Drew, this has been fantastic. Thank you for coming in. And Matt, thank you for making the introduction.
Of course.
Yeah, it's been fun, guys. Thank you for having me.
All right. Thanks, everyone. We'll see you next week.